Hey everybody, Marty Mazur, good afternoon. 12th of April 2016. I'm going to talk at you for a minute and go through a couple of charts with you. I'm going to look at my daily log and just kind of paraphrase my notes for you during the day. We started out higher, nicely higher, but that's been the case for the last few days, and then we traded off lower, which is consistent with what I've been telling you about my view, at least of this market from a technical standpoint, at least in the short run. But upon news that Russia and the Saudis, and this came from a Russian news agency, it was not confirmed by any energy authorities from either place, but I think it was a believable story that they have agreed to freeze production at, I presume, current levels, despite whatever Iran plans to do. And in fact, let me show you this on this. You're looking at a 3-day chart. This was Friday, Monday, and Tuesday. See how Friday the market started higher and then gave up the ghost. Monday started higher and then gave up the ghost. Today started higher, then gave up the ghost. But when I narrow the focus here and add oil, as you'll see on that news from the Russians, which was right here. Look at oil spike and look at stock spike. And now, for a day at least, we're back to that virtually perfect correlation between oil and the stock market. So you can thank oil for the market rally today. And I also think you can thank folks who were short. There's still, I got my short interest report today. There's still a great deal of short interest across almost every sector. Actually, that's not telecom. There's very low short interest. It was the one that actually saw an increase, but still at very, very low levels. So, but again, for the market overall, short interest is relatively high relative to where it's been of late. In energy, though, by far the highest shorted area were energy stocks. And of course, they got the biggest bump today, along with oil. So again, just as a reminder, what that means is there are people out there who were betting that the market's going to fall, particularly energy stocks, and therefore they borrowed through their brokers. They borrowed shares from other people and then immediately sold them. They have to pay back those shares, so they got to pay back that loan with shares. And what they expect to do is buy the same shares at a lower price, replace them, and pocket the difference and make a ton of money in the process. Well, the problem is when the stocks go up or the commodity goes up, whatever you're shorting, against you and doesn't go down, you run the risk of having to pay a higher price than what you sold it at and end up losing a phenomenal amount of money in some cases in the process. So it's not unusual that, in fact, it's very common that when there's high short interest and you get a surprise and the market moves against you, that these shorts rush to buy. Now that buying exacerbates the upside. So looking at the short interest in energy and looking what happened here, and it really, though, it all boats, rose with the tide. But commodity-related stocks, oil-related stocks certainly rose the most. It was a good day for financials as well, which was good to see. So I guess that makes me a skeptic about today because I really didn't expect it. I really expected today to drift, to start higher, as it did, and then drift lower and continue to drift lower, and at some point break down further to the downside, despite the potential positives that might come from any earnings season. At least that's what the technicals were telling me. This doesn't necessarily change it, but it does, it does do a few things. Let me show you my very noisy, I apologize. Let me clean it up just a little bit. Let me get oil out of there. The daily chart, 1-year daily chart. So you see now this shaded area, that's just a very defined channel from this low through this low, which takes us back from this high and this lower high. And basically, I noticed that it falls right on that trend line. So believe me, technicians are paying very close attention to that channel. And what's interesting about this trend line here is you can go back to the end of last month, so pushing a couple weeks now. That's been a barrier that the market just can't seem to get over. It's lived above it a day or two or three at the close. It did today, only to give up the ghost each time. And as I've been telling you with other volume indicators and so on, that it just didn't look like there was much upside commitment. Today was a little better from a volume standpoint, but we're going to need to see it trade above there and then start bumping below this as support before we continue to make new highs. That's looking at it from a technical perspective. So again, today was a better day for the bulls. I feel better about it, but I do attribute it mostly to short covering, but that's okay. Good rallies always start with short covering if there's a lot of short interest like there is currently. The question is, was the reason for the covering a reason to see stocks trade higher? And that remains to be seen. Of course, we're in earnings season. If you're catching the financial news at all, you keep hearing how the expectations are absolutely abysmal. Well, we're expecting a very poor season, but actually expectations have been getting better. If you look at the spread between earnings revisions to the upside and to the downside, they're net negative, but only by about 3%, and that's a very low spread compared to what we're used to seeing. The market actually does better when there's a greater spread between the negative earnings or revisions and the positive ones. So that's not necessarily a great sign. It's still negative, which would be good. So it's kind of a contrarian view that the market tends to do better when the sentiment is lower about earnings because it's easier for companies to beat. I think that this particular earnings season, the outlooks are going to be critical. We're not seeing revenue growth. I'm not seeing it so far in the few companies that have reported, just a couple so far, and they both missed on the revenue side. But we're going to have a ton over the next few weeks and some big banks later this week, so that'll be important. We got to see revenue growth. We've got to see productivity growth. We're not seeing that. We're seeing some earnings growth, but that's just through, creative accounting and cost cutting and so on. The market's going to need to see that. So the outlook for revenue growth might improve, particularly with the big multinational companies, the U.S. exporters, because the dollar has been weaker. And there seems to be this view that the dollar is going to stay weaker this year, and that has been my view for months now. So if that's the case, we could get pretty good outlooks, and that would be a case to be made that even in the nearer term, the market has some upside. I see June 23rd as a problem. That's when Great Britain votes. It's a referendum as to whether or not to stay in the European Union. I'll be shocked if they vote to leave. But the polls, suggest that there's a chance. And that would be a big deal. It would be a very big deal in the currency markets. We're seeing it already. And it would be a big deal in the global equity markets if they did, which means it could be a big deal just out of uncertainty leading up to it. Then you've got the seasonality. May, the June area time is just not necessarily or usually a good time for stocks. It certainly can be. There's nothing about seasonality that says it has to come true every year, but you've got that working against it. So like I said in my interview last week, that's the next headwind once we get past earnings season. And then after that, it's going to be dealing with the next Fed rate increase, assuming we come through the European or the Great Britain referendum unscathed, and the economy is still doing relatively okay. It would make sense, and the Fed seems to be committed to a couple rate hikes this year. Of course, that's all subject to change based on the data. And then when you really get technical, you can see I drew a couple of red lines here. That's been the trend here for the last week or so. The market goes down to about 2045, maybe a little below, then traders buy it back up to about 2060, maybe a little bit above. Today it closed about 2062. But it just kind of plays around in that area. It's going to break out in one direction or the other. It would make sense to me, maybe I'm a little less committed to it than I was, say, just a few days ago, that the breakout is to the downside, because I can make a case that we get an upside breakout before we really struggle coming up against that June referendum. So folks, this is in closing, and I'll say it as I say every time. This is me helping you just kind of prepare, or me preparing you for a great deal of volatility in this market given the headwinds and the tailwinds. So I say the volatility will be big in either direction. I said that the other day. I expect big days in both directions. Today was a big day to the upside. More of that, but it should not really call into question or change a well-diversified, well-balanced global equity portfolio. I think we should be very constructive and very positive in the longer term. But we've got to get through a very interesting 2016 along the way. I'd say there's probably a little more bearish sentiment out there for the year than there is bullish, and that's generally a good thing. The market tends to do better when there's a lot of people bearish, because that means there's a lot of folks on the sidelines, and there's a lot of folks who are short that have to cover when they ultimately get proven wrong, and that's just a matter of time. So thank you for that, for sticking with that very long 10-minute monologue, and I'll talk to you again very soon. Bye-bye.